Stop scrolling?
Because what was just released may completely change how you look at the housing market in 2026. The U.S. Bureau of Labor Statistics dropped the January jobs report on February 11th, 5 days late due to a partial government shutdown. And on the surface, it looked strong. But underneath, it tells a very different story. If you care about interest rates, home prices, or whether now is the time to buy or sell, you need to understand this. Non-farm payrolls increased by 130,000 jobs in January. Economists were expecting around 55 to 60,000. That's more than double expectations. The unemployment rate? It dropped from 4.4% to 4.3%. Wages rose 0.4% for the month, up 3.7% year over year. Average weekly hours increased slightly to 34.3 hours. On paper, this looks like a resilient labor market. And when the labor market looks strong, the Federal Reserve pays attention. After this report, traders immediately lowered expectations for a March interest rate cut. According to the CME FedWatch tool, the Fed is now more likely to remain on hold until at least June. Translation for real estate? Mortgage rates may stay elevated longer than many buyers hoped. That impacts affordability. That impacts demand. And that impacts listing strategy. But here's where things get interesting. Because the headline number isn't the full story. Not even close. Buried inside this release was something much bigger than January's gain. The government revised total 2025 job growth down to just 181,000 jobs. Previously, they estimated 584,000. That means last year's labor market was dramatically weaker than we were told. Total U.S. payrolls were revised down by over 1 million jobs, and revisions between April 2024 and March 2025 down by 898,000 jobs. That's not a minor correction. That's a reality check. The soft landing narrative? It may have been happening on much thinner ice. Hiring is highly concentrated. Healthcare and social assistance added 124,000 jobs. Construction gained 33,000. Manufacturing? Still weak. Private reports earlier in the month showed losses there. So this isn't broad-based growth. It's concentrated growth, and that matters for housing. Construction strength supports supply. Healthcare hiring supports suburban demand. But manufacturing weakness can hurt certain regional markets. This is a slow hire, slow fire labor market. Stable, but not booming. Wages rose nationally by 0.4%, but the gains weren't equal. Financial activities, up 4.1% year over year. Information and tech, 3.2%. Construction, 4.8%. Leisure and hospitality, 5.3%. Education and health, 4.5%. The highest wage growth is still happening in lower wage service sectors. That tells us something important. The frontline labor market remains tight. And here's the big one. Inflation is hovering around 3.1%, meaning for many workers, real wages are finally growing again. That supports consumer spending, which supports housing demand. But wait, there's one more twist. The 5-day government shutdown created statistical noise. Federal employees furloughed during the survey period may show up differently between payroll and household surveys. That can distort unemployment readings. Survey processing was delayed, which means this 130,000 number may be revised later. There was also a brief dip in consumer spending in DC and military-heavy areas. That could show up as weakness in February's report. In other words, January may look strong, but volatility isn't over. Here's the bottom line for real estate. The labor market is stable, but fragile underneath. Rate cuts may take longer. Mortgage rates may stay elevated into spring. Wage growth is real again, which supports buyers. But last year's weakness tells us momentum isn't explosive. We are in a transition market, not a crash, not a boom. Strategic positioning matters more than ever. If you're a seller, pricing precision is critical. If you're a buyer, watching Fed policy is essential. Because this labor market, it's a tale of two realities, a sudden January surge, and a much weaker 2025 than anyone realized. If you want weekly breakdowns that connect the economy directly to real estate strategy, subscribe. Because in 2026, information isn't power, interpretation is, and the agents, buyers, and sellers who understand these shifts first win. Now let's localize this. If you operate in Maryland or Washington, D.C., this jobs report carries extra weight. Why? Because this region is heavily tied to federal employment, government contracting, healthcare systems, and defense spending. And remember, this report was delayed due to a partial government shutdown. That matters here more than almost anywhere else in the country. Federal workers who were furloughed may still show as employed in payroll data, but spending behavior temporarily changes. During shutdown periods, we often see slower pending contracts, hesitation from government buyers, temporary dips in DC retail and service spending. That doesn't crash the housing market, but it can delay decisions. And in a market already facing affordability pressure, delays matter. Now, here's the positive. Healthcare added 124,000 jobs nationally. That directly supports Maryland's suburban markets. Think Montgomery County, Prince George's County, Howard County, Northern Virginia corridors, hospitals, research institutions, NIH, biotech. Those sectors are strong, and that supports steady buyer demand in mid to upper price ranges. Construction added 33,000 jobs. That's important for Maryland's supply problem. New construction in outer Beltway communities could increase slightly. But here's the reality. Inventory is still historically tight in most DC metro submarkets, so this isn't a flood of new homes, it's gradual pressure relief. The bigger local concern isn't January's strength, it's the massive downward revision to 2025. If last year's job growth was much weaker than believed, that suggests the DC metro economy was running cooler than assumed. And when growth slows here, luxury and move-up segments feel it first. Not entry-level, not FHA buyers, move-up buyers and high-income professionals. That's where pricing discipline becomes critical. Markets reacted immediately. When the 130,000 job gain beat expectations, Treasury yields jumped. The 10-year Treasury, which heavily influences mortgage rates, ticked higher as traders reduced expectations for a March rate cut. Why does that matter? Because mortgage rates track the 10-year Treasury more than the Fed funds rate itself. When yields rise, mortgage rates typically follow. Stocks reacted in a split fashion. Financials and bank stocks saw support because higher for longer rates protect margins. Rate-sensitive sectors like tech showed volatility. Why? Because fewer rate cuts mean tighter financial conditions. This wasn't panic, but it was repositioning. Investors recalibrated. For real estate professionals in Maryland and DC, this matters immediately. If the 10-year Treasury continues climbing, Mortgage rates could remain elevated through the early spring market. That affects buyer affordability, seller expectations, days on market, pricing strategy. This report may not crash anything, but it may delay relief. And in a market built on anticipation of lower rates, that shift is powerful. So here's the full picture. January hiring surged, unemployment fell. Wages are finally beating inflation. But 2025 was far weaker than originally reported. Treasury yields moved higher. Rate cuts may be delayed. And in Maryland and D.C., where federal influence runs deep, economic shifts hit differently. This is not a boom, not a bust. It's a strategic market. And the professionals who understand how labor data connects to local housing demand will dominate 2026.
Your ultimate hub for real estate insights, breaking news, entrepreneurial wisdom, investing strategies, and self-development hacks. If you're ready to expand your mind and stay ahead of the game floor, you're in the right place. Subscribe now. Your future self will thank you.